The global economic landscape is undergoing significant shifts as BRICS nations aim to reduce their dependence on the U.S. currency. China's recent move to offload a staggering $50 billion in U.S. bonds has sparked widespread discussions about the future of global finance. What's behind this move, and what are its potential implications for the United States and the global economy? In the vast universe of investments, where the stock market often overshadows other assets, the bond market takes center stage, shaping economic flows and influencing financial strategies worldwide. A glance at the global financial map reveals not only individual investors but also entire nations seeking to allocate their capital. At the heart of this complex world lies the U.S. bond market, perceived as a bastion of stability and reliability. The scale of this market is astounding, estimated to be 3 times the size of the global stock market. The reason for this dominance lies in the very nature of these financial instruments. Stocks represent ownership of assets, while bonds are essentially debt obligations. It's logical that the volume of debt in the global economy will always exceed the value of assets owned. This situation raises a paradoxical question. How can interest on loans be paid in a system with a limited money supply? If all the money is already in circulation, where will the funds to repay the interest come from? The answer is clear. New debts must be created to service old ones. In this ironic reality, the bond, this humble piece of paper, becomes not a symbol of ownership but an instrument of debt dependency. The United States of America is mired in debt, which has already surpassed $34.8 trillion. This debt, represented by bonds, is actively sold worldwide, attracting investors from various countries. Currently, foreign governments hold between $7 and $8 trillion of American debt. To sustain economic growth and repay old loans, it is vital for the U.S. that its government bonds are in demand both domestically and internationally. In return, bondholders receive interest, a form of dividend. If American bonds were stocks, they would be rated AA, corresponding to the status of blue chips, some of the most reliable and profitable assets on the market. That's why countries worldwide hold trillions of dollars in their accounts, expressed in American debt. Interestingly, this debt burden is a valuable asset for the countries that hold it. However, the situation is gradually changing. China, once one of the largest holders of American debt, is reducing its purchases. Japan, another key lender, also shows a tendency to decrease its investments in U.S. bonds. So, what impact does this situation have on the U.S. economy? It's important to note that China has traditionally been one of the largest investors in American debt, and even today, it remains the second largest holder of U.S. bonds. However, the first quarter of 2024 saw a trend of reduced Chinese investment. The PRC sold approximately $50 billion worth of American bonds, reducing its portfolio from $816 billion in December 2023 to $767 billion in March of the same year. Notably, this reduction occurred in just 3 months, and this trend is not new. Over the past decade, China's reserves in U.S. bonds have steadily declined, reaching their lowest level in 14 years. Several factors contribute to this development, but one of the main ones is the continued strained relationship between the U.S. and China. The origins of these problems date back to 1949, when the People's Republic of China was founded. A period of warming relations began in the 1970s, when President Nixon made a historic visit to China, becoming a sensation in the world. The decision to establish diplomatic relations between the U.S. and China at the time amazed the world. Observers at the Washington Post wrote that the news of the American moon landing would have caused less astonishment. However, by 1979, what seemed unthinkable had come to pass. In the 80s, despite the tragic events in Tiananmen Square, relations between the two countries grew stronger, fueled by burgeoning economic cooperation. In the 2000s, the situation began to change. China, like any country striving for greater influence, declared its ambitions on the world stage. Talk of unfair trade policies of the PRC grew louder. But there was one question that worried Americans, especially China. Under President Donald Trump, the 2010s marked the beginning of a trade war, the tension of which persists to this day under President Joe Biden. A new round of confrontation was the introduction by the United States of new tariffs on Chinese electric vehicles. This is not about symbolic 10 or 20%. The Biden administration has set a duty of 100% on Chinese electric vehicles. The United States of America continues to face challenges in maintaining trust on the world stage, especially in such sensitive areas as technological leadership, issues of censorship, respect for human rights, and the Taiwan issue, which is a key element in relations with China. The economic rivalry between these two powers remains acute in 2024. As a result, the global community is revising approaches to economic cooperation, seeking to reduce dependence on the American dollar and, perhaps, even put an end to it. The basis for such sentiments are graphs showing a gradual decline in the share of the dollar in global reserve currencies since the United States abandoned the gold standard. At one time, the decision to temporarily suspend the convertibility of the dollar into gold or other reserve assets was made to ensure currency stability and protect the interests of the United States. Currently, the question arises about the potential consequences if countries, including China, begin to actively get rid of U.S. Treasury bonds. A global sell-off of bonds will inevitably lead to a fall in their value, which, in turn, will provoke an increase in interest rates. This situation creates serious pressure on the banking system, while simultaneously increasing the cost of borrowing. More expensive loans, in turn, will lead to a reduction in lending among both the population and the corporate sector. A decrease in consumer activity will naturally slow down economic growth. The impact of high interest rates also extends to the federal budget, increasing the deficit, which will inevitably affect the financing of social programs that play an important role in the lives of many citizens. The state may have to resort to raising taxes to cope with rising interest payments. The stock market will also feel the consequences of what is happening, facing unpredictable turbulence. Those who plan to retire will be especially vulnerable, since similar situations have not arisen in the past, and the market lacks historical benchmarks, which will only increase volatility. Fourth, the value of the dollar requires close attention, as such actions are capable of undermining its reputation as a reliable global reserve currency. If demand for U.S. debt obligations declines, the dollar's position will weaken. Fifth, a weaker dollar will inevitably lead to higher prices for imported goods, which will create additional pressure on consumers. In turn, the Federal Reserve System will have to resort to further raising interest rates to curb inflation. Sixth, the combination of these factors could trigger a global recession. However, there is an alternative point of view, according to which such fears are greatly exaggerated and nothing threatens the dollar. In this regard, the well-known expression comes to mind: if you owe the bank a small amount, then you have a problem. If you owe the bank billions, then the bank has a problem. In this context, the United States acts as a bank, and other countries are holders of American debt. China should not rush to get rid of American Treasury bonds, because such a step could lead to a collapse in the value of its own investments. The U.S. dollar still maintains its strong position in the global economy. According to a study by the Council on Foreign Relations, about 59% of global foreign exchange reserves are held in U.S. dollars. For comparison, the share of the euro is 20%, and the Chinese yuan is only 3%. The Atlantic Council reports that the dollar is used in 88% of transactions in foreign exchange markets. Despite the fact that China is gradually reducing its dollar assets and American bonds, 73 other central banks around the world prefer to get rid of the Chinese yuan, increasing their reserves of gold and dollars. A survey of investment house managers showed that the American dollar is the most optimistic in the perspective of the next 1 to 2 years. 18% of respondents stated their intention to increase investments in the dollar, which is 3 times higher than the previous year. The euro took second place with 7%. At the same time, surveys show that about 12% of investment portfolio managers express their intention to reduce investments in assets denominated in Chinese currency. Considering the dynamics of the dollar through the prism of the DXY index, one can notice its steady upward trend over the past few years. One of the key reasons for this phenomenon is the attractiveness of high interest rates in the U.S. for international capital, which stimulates the inflow of investments into American debt. However, a legitimate question arises: how ready is the U.S. to lower interest rates in the face of active sales of its debt obligations? This question, which deserves a separate detailed analysis, leads to the main conclusion: the dollar's position remains very strong. The data presented above, based on objective research and statistics, paints a picture of the current state of the global economy. Regarding personal opinion, it is worth noting that the process of gradual departure from the dollar's dominance in the global economy has been observed for several decades. The question of how quickly the world is abandoning the dollar and what the consequences of this process will be is a subject of lively discussion. Perhaps what is happening today is just part of a cyclical dynamic, where periods of dollar strengthening, driven by high interest rates, are replaced by moments of its weakening, as happened after the U.S. abandoned the gold standard. In other words, the strengthening of the American currency may only be a matter of time. Some economists argue that reducing the dollar's dominance in the global economy could benefit the United States by increasing its competitiveness in the global market and stimulating the growth of the stock market. However, most experts agree that maintaining the status of a world reserve currency remains a priority for the U.S., providing them with the greatest economic advantages. Despite the fact that no currency can currently compare to the dollar in terms of its use in international settlements, the United States is increasingly using it as an instrument of political pressure, imposing sanctions and applying tax measures against other countries. Uncertainty in the global economy is pushing countries to look for alternatives to the dollar, accelerating the process of getting rid of the American currency. In times of instability, investors traditionally turn to gold, the dollar, and treasury bonds as reliable assets. The question of the future of the dollar's dominance remains open. Perhaps its influence on a global level will gradually weaken, but it is unlikely that any existing currency will be able to completely replace it in the foreseeable future. The euro has some potential to challenge the dollar, but the prospects for the yuan or a BRICS currency are still uncertain due to a lack of trust between the participating countries. Even the powerful economy of China faces problems that hinder the widespread adoption of the yuan. Any changes in the global monetary system are likely to occur gradually.